welcome to AP Macroeconomics, where you will learn a lot.
So in section 1 of Mr. Smith's AP Macroeconomics course, the main focus is just introduction to the macroeconomics, and one of the big concepts is the production possibilities curve, which measures how many goods can be produced given a certain amount of resources. And then you also learn about the comparative advantage and trade, so it's a big concept. And then after that, you move on to section 2, which is all about supply and demand, which is pretty self-explanatory. Like, supply is how much you have of something, and demand is how much the customers are going to want. The changes in equilibrium all depend on when the supply and demand curves intersect and what that price level is. And then
So section 3 of Mr. Smith's AP Macroeconomics class is measurement of economic performance, and it focuses on the circular flow and gross domestic product. And so that's basically how the economy functions as a whole, including households and the government. And then you have to account for real gross domestic product as well in module 11, because anytime you want to see how much people are producing or how much the country's producing, it's good to know how much that is compared to a base year. And then in module 12, you have the median calculation of unemployment. Unemployment talks about how many people are unemployed inside of your economy, and when unemployment is low, that means that your economy is going to be stronger. And the causes and categories of unemployment: there's cyclical unemployment, there's static unemployment, there's a whole bunch of unemployment. And the most part about unemployment is that you do not want to be unemployed. Inflation and overuse. So basically what happens in inflation is that you print a whole bunch of money, and then the whole entire money supply just expands. So when the money supply expands, you can't buy as much stuff. Like, say a latte used to cost you $4, but then the dictator threw a bunch of money into it, the latte would then cost $7. Anyways, so then we come to section 4, which is the national income and price determination. This talks about how prices are determined so that they're fair amongst the people. So this one talks about income and expenditure. So that's basically how much you receive on your paychecks and then how much you pay. And we talk about aggregate demand, which is how much the economy as a whole wants. And then you got to talk about determinants, which are like milk with cereal and like stuff like that, like substitutes, as well as their vice versa. And then when you talk about aggregate supply, that's how much the economy has as a whole. That also tells you how well the economy is doing. And so the equilibrium aggregate demand supply model, and that's the best, because when your economy is running at equilibrium, that means that you're going to be steady and you're going to be able to have steady growth. And when we talk about economic policy, we have to talk about how the government wants to handle how people are doing everything. And then there's also fiscal policy, and fiscal policy talks about how banks will govern, how they will distribute loans, what the interest rate will be, and everything like that. Section 5 of Mr. Smith's AP Macroeconomics course talks about the financial sector. And so this is talking about saving, investment in the financial system. What you got to think about when you talk about investment is that that's the money that you put aside to grow. If you don't put money aside to grow, you have no savings in your investment and you're not going to be rich. So anyways, you talk about module 23, the definition and measurement of money. This talks about how much money you got. Like, you could have racks or you could have little no stacks. So you just got to talk about the measurement of money. And then the time value of money, this talks about inflation. Because if you just hid the money underneath of your bed and waited like 100 years, it could be worth absolutely nothing. So all your work and everything could be worth nothing. So then we talk about banking and money creation. So the banks, they can create money, which causes inflation. And so we've talked about this before in module 4, and we don't like inflation. So we can also talk about the Federal Reserve System, the history and the structure of this. Basically, when the 2007 banking crisis happened, they had to reform the banks. And so what happened is that they created the Federal Reserve System to insure people $250,000 insurance. And essentially, we also have monetary policy. What monetary policy does is it basically protects our economy in case of unemployment and other things that can sway our LRAS curves. Anyways, the money market. We talk about the money market because you have to trade money with other countries, and other countries' monies could not be worth the same things. Like if a car there is worth like $20,000, it could be worth like 30,000 euros, this way, that. Anyways, the money for loanable funds, that's another big thing, because a lot of people, for big investments, when they buy houses, they need funds, so they go for loans, and loans cost money, which you have to make money. Okay. So section 6 of Mr. Smith's macroeconomics class also talks about inflation, unemployment, and the stabilizing policies to counter affect these effects. So module 30 talks about the long run implications, and when you talk about long run, you have to think about LRAS because it doesn't really change if you look at the long run scale, because the market always has to come back, otherwise people won't be able to live. So monetary policy and interest rate, that relates to how much banks charge you to give them money. So like if I was to borrow money from a bank, they would charge an interest charge so that I could pay it back. And then you talk about money, output, and the prices in the long run. When you look at the long run, as long as the market is doing good, whenever a country is stabilized, that's how you know a country is good because the prices are typically normal. They're not too bad. It's not like in Cambodia that one time when all of a sudden the toilet paper was like $60,000 and no one could buy toilet paper. So the types of inflation, disinflation, and deflation, it talks about how inflation affects and how it changes in the economy in a long run. Remember, macroeconomics is talking about the long run. So you also got to talk about alternative views of macroeconomics and the modern macroeconomic census, and that's basically all section 6 talks about. It was a pretty hard section. I definitely had some nights where I just didn't sleep because I was thinking about the section so hard. And then you talk about section 7, Section 7 talks about economic growth and productivity in the economy. When you think about productivity, you have to think about how an economy is being productive with their resources. When an economy is being productive, the economy will continue to grow continually. This is what Module 8 and Module 39 talk about. Economic growth and macroeconomic models talks about the different graphs that microeconomics has. And that's all we have.
So, section 8 is the final section of our macroeconomics class as it comes to the end, and we're all so sad about it. So, I brought in the famous Miss Snell. Do you know anything about section 8?
Well, I know it's the open economy, international trade, and finance.
And it appears to be. So, let me tell you guys about that. So, the capital flow and the balance of payment, it involves the balance of the monetary system and how the money flows throughout the nations and stuff. And then the foreign exchange market is how the money is exchanged internationally and from country to country. So like if the United States and France wanted to, bargain or do whatever they do with their money and exchange stuff, that's pretty much what this involves in a nutshell. The exchange rate policy is the money that you exchange, so the United States and France, how they're exchanging money, it's the rate at which the money is either, so $1 is not equal to €1 or whatever they use in Europe. So yeah, those are the exchange rates, and that's pretty much it for AP Macroeconomics. It was a fun class, fun time.